I had a question from the radio show. Did a show a little while back talking about stock market volatility and how fast markets can move. So if you're not in there when it goes up, you can miss a lot. Now the question was from Harry, and he says, hey, you had talked a little bit about this, that if you were out of the market during the 7 to 10 best days, you may have missed all of the return for the year. And he related this to a friend of his who said, that just seems too hard to believe. I can't believe that. And you can understand where the friend's coming from. You might have over 250 trading days in a year, and you're telling me that just missing a few days, you lose all of the positive return of the stock market? That seems crazy. Well, indeed, there was a study done from the University of Michigan, and they were looking at the period from 1963 through 2004, and what they found was that 0.9% of the best days gave you 96% of the returns of the stock market over that period of time. So miss a little and you can miss a lot. In fact, CNBC had an article and they were talking about how missing the market's best days, you may do that if you sell amid high volatility. Now think about it. When are we more likely to get scared and sell out? We might sell out when markets are downward volatile, right? And that's when we don't get worried about upward volatility. We might sell in downward volatility. Now, the thing is that we often will miss the upside return because the biggest days occur after those down days, and we're selling because we're trying to avoid more losses, you see? And that's where the problem comes in. We end up missing the good days. And they pointed out in here the top 10 days, the return. One single day from 2002 is the period of time that they were looking at. And they were looking all the way from 2002 through 2022, they found that the return in the best single days was anywhere from 6% to 12% in one day. Now, they went deeper than that, and they said, what we try to do is we want to try to take control of our portfolio, somehow make sure that we avoid losses and get in on gains, and often we think we're in control, but we're really not. They talked about a JP Morgan study in here, and they said that the 10 best days over the past 20 years occurred after the big decline. So that's why they were saying that it's such a bad idea to sell after you see market downside volatility. Furthermore, they said that if you put money in the stock market, $10,000 in the stock market from 2002, through 2021, but you missed the 10 best days, instead of your money growing to about $61,000, it only grew to about $28,000, so less than half. Big deal if you miss the best days. Now, what we also did in here is we were looking at research ourselves, and we found that the same thing. Fully invested from 2002 through 2021, you miss about half the return of the market. If you miss the best 20 days, you end up cutting your return to about a quarter. Miss the best 30 days, you're about at 1/6 of the accumulation. Big deal in a short period of time. Furthermore, we looked at it in different asset categories, large companies and small value, to see if we saw the same thing. What we did is looked at what if you were fully invested over the whole period of time shown here from 1983 through 2022. You notice that if you missed the best 1 month, you had a drop in return. The best 1 month return out of all those years, 40 years. What if you missed the best 3 months is the next bar. And then if you look at the next bar down, that green bar right there, you see what if you missed the best 6 months, and the blue one is the best 12 months out of 40 years. It's a huge deal no matter what asset category you're looking at. You missed a lot of return if you weren't in there during those best months. Furthermore, we looked at the S&P 500 and said, well, how many top days were needed? If we were in the market but we missed the top days, how many days did it take to give us all of the return in all of these given years? And you notice some years it's only 9 days give us all the return, 6 days, 2 days, 8 days. Some years when the market goes down, it doesn't take any, right? But if you miss those top days during down market years, you had even greater losses. So keep that in mind when you try to time the market. It's a loser's game. Trying to figure out what's going to happen next is a big problem for investors. We think that we can protect ourselves from downturns, but we often end up protecting ourselves from upturns as well.